Welcome to Chapter 3, and in this chapter we are going to cover something called the cost volume profit analysis. And you're free to go over these objectives in the chapter, but I think we're going to. But before we can talk about what the cost volume profit analysis is, we first have to define what we're talking about in terms of a contribution margin. So what is that? Well, the contribution margin calculation is sales minus variable costs. But what does this mean? Well, if we subtract our variable costs, our direct materials, direct labor, for example, from our sales, what we have left is our contribution margin. Well, okay, but what does this mean? Well, it is what is left over from our sales revenue after we've met our direct costs, and it's what's left to cover our fixed costs. Looking at contribution margin on a per unit basis helps us to better identify whether or not we're making money. Are we selling this product for enough in order to not only cover our costs, but to make sure that there's something left over for us in the end? So we're going to start with a little example here. We're going to use Hicks Manufacturing Company. They manufacture bird baths. They sell those to specialty retailers, and they've got a Blue Jay model that they sell for $100. The variable costs, direct materials, direct labor, is $20 per unit, and this leaves them an $80 contribution margin. And so let's look at that in terms of a contribution margin ratio, because sometimes putting it in terms of percentage is helpful in looking at percentage of sales that constitutes profitability. So in the above example, we've got our $100 bird bath, and the contribution margin is $80 per unit. So effectively, this gives us an 80% contribution margin. At any point that we keep our fixed costs below 80%, we make money. If we don't, then of course that is bad. So we're going to just divert from bird baths a second to a different example to, again, further illustrate this. So in this example, they want us to construct a contribution margin income statement. Now, remember, as managers, this is not a GAAP compliant income statement. This is going to be a management tool, and this is going to help us figure out whether or not we are meeting our targets and profitability. So in this example, we are going to sell 100 shirts for $25 per shirt. Now, what does that give us in sales? Simple math, $2,500 in sales. Are we selling them for enough? We don't know. So now we've got to figure out, of the costs that have been identified here, which are variable costs and which are fixed costs. So we know we've got $300 a month in rent. Does the rent change if we sell more t-shirts? Probably not. Most likely the rent is the rent. On the other hand, does the costs on t-shirts go up as we sell t-shirts? Yes. What about the commission? Well, if we sell no t-shirts, we pay no commission. So therefore, that's going to be a variable cost that's going to change with sales. What about the salary to our salesperson? Well, we're going to pay him to sit there all day at the kiosk, whether or not he sells any shirts. So that's going to be a fixed cost. Now we're going to jump back to our bird bath example. Fixed and variable costs are displayed in a contribution margin income statement. So we've got our top line, which is our sales. We then have our variable costs. In this case, at 500 units, we're going to assume. And that gives us our variable costs subtracted from our sales tells us that we have $40,000 left to cover fixed costs. Now, we better hope that our fixed costs, are less than $40,000. What happens if they're more? Well, we lose money. What happens if they are less? We are profitable. So in this case, we fortunately see that our fixed costs are only $23,000. Therefore, that remaining $17,000 after the costs have been covered are profits for our managers. And I'm going to just move this here. So now, rather than doing this kind of in an income statement format, we're just going to look at this mathematically. We've got our total sales, and we multiply that times the contribution margin ratio, and that tells us what our total contribution margin is in terms of dollars. We can use a little bit of math also to find our units sold using the contribution margin. So in this example, we're going to assume that we had an total contribution margin in April of $40,000 and a per unit contribution of $80 per unit. So total contribution margin over the per unit contribution margin tells us how many units we sold during this month. Now, often this is an analysis that can be used to evaluate two potentially incompatible scenarios. Now, as a business owner, we might like to accept every opportunity that comes our way, but we can't always do that. So sometimes because of limitations in production capacity or sales capacity or whatever, we have to choose one or the other. We don't have enough staff, and our machines can't produce enough to be able to satisfy multiple orders, for example, on maybe incompatible timelines. So you can use this analysis to decide whether you're going to take order A or order B based on what is going to generate the greatest profits for you in the end. We can also extend this analysis to figure out what our break-even point is. And what's that and why is it important? Well, the break-even point is the point at which we can sell a product for just enough to cover all of our fixed and all of our variable costs. It leaves us nothing left over for profits. The upside of that is that it leaves us at least having covered our costs and not having lost money on the analysis. And so this break-even analysis is not only a way that a company ensures that it isn't losing money in the way that it prices and the volume of products that it sells, but that it can also hit target profits. Companies such as Starbucks do this regularly. Starbucks is going to manufacture and sell lots of different things during the course of a day. Well, it may not manufacture all of them, but certainly you've got, coffee to go. You might have prepared foods in the case. You have, some product that they're selling off the shelves. And a company like Starbucks has to be able to determine what the contribution margin is of each of those products to determine whether or not they are losing money on a given product, because a given or perhaps not charging enough and are therefore losing money. What you don't want to have or want to try to avoid having is a product that isn't generating enough of a contribution margin to cover not only its variable costs, but its share of the fixed costs, such that it then has to rely on other products and services to potentially cover its share of the costs. Now, we can look at this break-even analysis kind of in a graphical form, and we'll come to some examples in a few minutes, but sometimes a picture paints 1,000 words, sometimes it's just a picture, but we'll see. So on the vertical axis here, this is represented in dollars. The horizontal axis is units sold. So at the corner here, we are assuming 0 units sold. And $0. The line which starts off lower, this is our revenue line. The line which starts off higher, this is our cost line. The point at which and we hope that our revenue line grows at a steeper incline than our cost line does. If not, we will never achieve profitability. But assuming that our revenue ultimately at a certain point will outpace our costs, that will allow us to then sell for more than it's costing us. The point at which these two lines intersect is what's known as the break-even point. Anything that we sell in terms of units that it falls below that break-even point is going to generate a loss. In other words, you see our sales line is in dollars less than our cost line is in dollars. So we are selling for less than it is costing us. But again, at some point these lines intersect and then cross, and what we are selling the items for is higher than what it's costing us to make them. We're going to go back to using the data from Hicks Manufacturing to look at this break-even analysis. Now, this slide might look a little different than what you have in your materials. I did a little doctoring here because I wanted you to have the data here on the next slide that we were referring to. So the break-even point in units is the first step in calculating what we need to do in order to break even. So the calculation for that is our total fixed costs, which in this case we just take right out of our chart of 18,000, and we divide those by the contribution margin ratio, or contribution margin per unit, I should say. So we know that our contribution margin per unit is $80, and so 18,000 divided by 80, that tells us our break-even point in units. Now, in order to figure out in sales dollars what that translates to, we take the break-even point in units and we multiply that times the per unit selling cost. So this tells us that we must generate $22,500 in sales revenue before we break even. We don't make money, we don't lose money, we just cover our costs. And here is an income statement that sort of tests that. We've got our sales at 225 units at $100 per, it says per return. I think these are, it should say per sale. And that generates $22,500. Now we've got variable costs, $225, 225 units at $20 a unit for our materials and our direct labor. So if we subtract that from our sales, after we've covered our variable costs, we have $18,000 left over to cover fixed costs. And lo and behold, our fixed costs happen to be $18,000. So we are just able to cover those, and there is nothing left in terms of profit. Now, if we look at that from the graphical representation that we just talked about in terms of birdbath units, we see here at 0 sales, we still have $18,000 in costs because our fixed costs are still there whether or not we sell a single thing. And as our sales climb, so do our costs because we're also incurring variable costs with each sale. Again, hopefully the sales line increases at a steeper incline than the cost line, and that these two lines intersect, and eventually we continue to sell into profitability land because now our sales dollars exceed our cost dollars. But what happens if Hicks only sells 175 units. So remember, it took 225 in order to hit 0, that break-even point. So in this case, we've got 175 units at $100 per unit. And so that has us with a sales revenue of $17,500. Our variable costs are less because we've now sold 50 less units than we did in the first example, so they're at $3,500. If we subtract that from the sales, we now have a contribution margin of $14,000. Well, our fixed costs are still $18,000, so we have now a $4,000 loss. We can also see that illustrated here on our graph. At this $175 point, we haven't even generated enough. If we follow this over to the dollar mark, the $17,500 doesn't even cover our fixed costs, let alone the variable costs that we were incurring to produce the 175. So if this was all we made, we would say that this is a loser, and you know, we would certainly want to step back and determine whether or not we think that sales show chances of improvement. And I think that this is also a cautionary tale too about whether or not you decide to pull the plug on something. If somebody just came in and looked at this and said, wow, only 175 in sales, this is a losing product, we need to pull this off the shelves. But wait, if you look at the trajectory, and there's a reasonable belief that this trajectory could continue, if you just sort of stay the course and hang in there, the shift will eventually turn around as long as the sales volume continues to go up. And once we've passed that break-even point, again, it will continue to outpace our costs. We can also look at it in terms of a sale of 300 units. So what does that do for us on our income statement? Well, that boosts our sales up to $30,000, our variable costs up to $6,000, but now that leaves us $24,000 in terms of a contribution margin. Now our $18,000 in fixed costs remain the same, so after we've covered those, we have $6,000 to put in our pockets. And once again, we're going to look at this on the graph, and we see now here we are at the 300 mark, and we see that we have now surpassed in dollars in sales where we are at in terms of costs at this point. And so once again, at any point that our sales are above and beyond this break-even point, we have profitability. Now, whether or not profitability whether it's enough to justify the efforts, or whether it takes away from efforts that could cause the company to be making more profit someplace else, is again a decision for management. You know, looking at that break-even point, we looked at it first in units. Another way of looking at it in terms of dollars, which is our fixed costs divided by the contribution margin ratio. And these are just basically a way to show you that these are multiple calculations that all lead you to the same break-even analysis. It just depends on what angle you're approaching this from. Do you already have your sales and variable costs information, or you know, what information do you have in order to make these calculations? And that will lead you to the various conclusions that you see here in terms of break-even point, units, dollars, contribution margin ratio, but again, all of these are different ways of saying the same thing. Now, these next couple of slides here, which are in your materials, I'm not going to go over. They lead you through some practice. The solutions are here as well, which will hopefully be self-explanatory. And I am going to pick up the next video with the next slide.